On October 19, 1987, panic swept across global markets. The Dow Jones Industrial Average, one of the oldest and most trusted measures of U.S. stocks, plunged 22% in a single day. To put that in perspective, that's the equivalent of the Dow falling over 7,000 points in one trading session today. But what made that Monday truly historic wasn't just the size of the crash. It was the cause. For the first time in history, the panic wasn't driven by human traders, it was driven by computers. In the mid-1980s, Wall Street was embracing innovation. Banks and investment firms were adopting new tools to manage risk, early versions of automated trading programs. One of the most popular systems was called portfolio insurance. The idea sounded simple. If stock prices fell, the computer would automatically sell futures contracts to limit potential losses. But there was a hidden danger. Everyone was using the same strategy. So, when prices started to drop that Monday morning, these programs all began selling at the exact same time. As stocks fell, the algorithms triggered even more selling, creating a feedback loop of panic. Human traders couldn't keep up. By midday, the sell orders were overwhelming the system. Market makers couldn't find buyers, and prices spiraled lower with every tick. By the closing bell, the Dow had lost 508 points, wiping out more than $500 billion in market value. Other markets, from London to Tokyo, followed within hours. It was the first global, technology-driven financial meltdown. In the days that followed, investors were terrified. Was this the start of another Great Depression? For a moment, it seemed possible. But the Federal Reserve stepped in quickly, reassuring banks that liquidity would be available and urging calm across financial markets. That response restored confidence. And then something remarkable happened. The market began to heal. Within 2 years, all the losses had been recovered. The economy never fell into recession, and investors learned a valuable lesson about the limits of automation. Regulators also took action. They introduced circuit breakers, automatic pauses in trading when markets fall too quickly, to prevent a cascade of panic selling. Those same safeguards still exist today and are used whenever markets swing sharply. Nearly 4 decades later, markets move faster than ever. High-frequency trading algorithms can now execute thousands of orders in microseconds. Artificial intelligence is increasingly being used to predict and react to market movements. The tools have changed, but the psychology hasn't. When fear spreads, even the smartest systems can't stop it. We saw echoes of Black Monday in events like the 2010 flash crash, when the Dow suddenly dropped nearly 1,000 points in minutes before rebounding. Again, due to automated trading feedback loops. Technology amplifies both efficiency and emotion. Technology evolves, but human behavior doesn't. Black Monday reminds us that even in an age of algorithms and automation, the core of investing is still emotional discipline. At El Castillo Investments, we believe the best investors don't try to predict every market move. They prepare for volatility through diversification, long-term perspective, and patience. Because whether the orders are placed by traders or machines, the principle remains the same. Control what you can and stay calm when others panic. Visit elcastilloinvestments.com to learn more and follow us for more financial insights.